Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Mark Chandler. We're going to recap that CPI data from last Thursday because of the market shift that we saw on the back of that data, and because we didn't get Mark on last Friday. We're also going to get Mark to outline some of his targets for the markets, even the precious metals, and potentially go into what seems to be everyone's favorite topic right now, the Trump trade. What could happen if Trump is elected? Mark, starting off with the CPI data from last Thursday, it seems like that lower than expected inflation data has really solidified a Fed rate cut coming up, most likely in September. We've seen small caps take off, interest rate sensitive stocks take off on higher volume. What's your thought about this? Is this just the start of a more sustainable run?
Yeah, you're right. I think that there's only a couple of data points that really drive the markets these days. The CPI, US CPI is one of them, non-farm payrolls is the other. And we did get that lower than expected CPI report. And the market sort of went into it basically with selling pressure on the dollar and pushing US interest rates down. We had some follow through on both the dollar index falling through 104, and we saw the interest rates, both say the 2-year and the 10-year, fall further. I think that what we've seen though in the past couple of days, so we had a reaction to the CPI and PPI, that's the 11th and 12th last week. Some follow through early this week, but now I think that move that really began, I'd say, in late June or early July is over. And we should be looking in the next week, 2 weeks, till we get the jobs data, or the run up to the jobs data on August 2nd. We should be looking at higher U.S. interest rates and a stronger U.S. dollar. I think that CPI solidified those expectations, like you said. I think the Federal Reserve officials have recognized it. 3 months of good data from the from the inflation side, which helps boost the confidence. I think that we've seen the Federal Reserve a consensus. The Federal Reserve officials say, yes, it's been a good data. We're not quite there yet. And I think that by the time the Federal Reserve meets in September, they'll be there. Now, we do get a meeting, of course, the FOMC meeting later this month. And there, I think Powell will just lay out the groundwork, expressing that confidence, that a combination of slowing of the U.S. jobs market, and we saw that again with another rise in the weekly jobless claims this past week, and the easing of price pressures. I think that Powell will give us a closer signal, reaffirming what the markets got priced in, and that is a cut in September.
Well, Mark, if you expect interest rates to go back up and the U.S. dollar to go back up, what impact does that have on the markets? What impact does that have on commodities? Give us your thoughts there.
Yeah, sure. So I think that what an incredible stock market rally we've had. Think about this. Since, say, mid-April or so, both the S&P 500 and the NASDAQ rallied more than 20%. I was talking with my brother the other day, and we were talking about our stock portfolios, and I said, listen, if someone would have told you at the beginning of the year that you could be up 15% for the whole year, wouldn't you take it? And I think that's where a lot of investors are now. They might not have done as well as the S&P 500. There's money on the table, and I think that with the changing tide of Fed policy, and again, the reason the Fed eases is not because they're optimistic about the economic outlook. They're easing because understanding the lag time with monetary policy, they are growing concerned about the economy 3 and 6 months from now. And so it seems to me that this is the time to be taking some money off the table and looking for a pullback, a more sustained pullback in the stock market. I'm just looking at, if you want to play this game from home, just looking at that correction of the move since, say, late April. That would bring us down to about 5,400 in the S&Ps. And so that's a little bit more than 100 points from here. And that's like a minimum target, right? So about another 100 points lower in the S&Ps. And that puts the NASDAQ around, call it 17.3. And we're trading about 17.7 now on NASDAQ. So looking at a few percentage points pullback from here. And again, those are minimum levels. And I know the temptation is going to be to jump in early. This has been the big pullback people have been waiting for, and the tendency would be to jump in prematurely. So I would wait for some more convincing sign, and besides just a price level target, that a bottom's in place. We've come quite far, and valuations on various measures are very stretched. And this is the sort of time as the earnings season gets underway proper that you'd expect to see some pullback, and we've got it.
Do you think something like the Russell, the small caps, or any other sector could hold up during that market pullback and kind of that rotational money theory that we've been seeing?
Yeah, I think we need to be careful about this because I think that there's a difference between institutional investors who have the wherewithal and the leverage to say short the S&P 500 and then buy the small cap index. They're playing the relative value. But when we do it, retail investors, what we will do is we might lighten up on our S&P 500 and buy the small caps, but we're still really exposed to the market directionally. And just because I can imagine a scenario in which S&P 500 sells off harder, but that the small caps also weaken. But we can talk about that a little bit when we talk about the different Trump trades too, because the small caps are thought to benefit from a higher tariff environment that might be a result.
Well, let's kind of get into that, but I'd also like you to weave in what you think may happen to something like the safe havens of bonds or precious metals, because if people are going to sell stocks, many people get into the bonds in a bigger way. But if you think rates are going up, that would probably be a bad trade. What about something like gold, and what are some of the other implications you think could be setting up?
Sure. So yeah, I think the combination then of what would it be would be a stronger US dollar, higher US interest rates. And I think what that means is that gold's got to correct lower too. And I think we're already seeing it crack. So gold made the record high, like I say around the same time as the euro made its high around 109.50. Same around roughly the same time that sterling would made its high for the year. We're looking at July 17th, so only a couple of days ago, gold was at 24.83, a record high, and today we are falling through 24. So my initial target on gold, I think we break down through here. This is a little bit steeper of a loss than I thought we'd have today. I thought maybe at 2400 could hold. Now I think if we break through 2388 or so, we could head towards 2350. And I'm not necessarily convinced that's going to hold, but I do think that we hold above 2300, and that's sort of the lower end of the range that we saw in June. So stronger dollar, higher U.S. interest rates, I mean a weaker gold, even though the stock market's coming off as well. So gold not so much a safe haven, but just really the mirror image, the uncola, if you will, to the U.S. Coke of the dollar and interest rates.
Mark, to that point, it's something I've been asking people throughout this week too, is that gold and the stock markets have moved in tandem over the last few years as both have materially appreciated. Gold up around 50% since late 2020 low or 2022 lows. Stock market pretty much the same. If you do a gold to S&P chart, is this a trend where these two move in tandem for a longer period of time, or what breaks this correlation?
Yeah, I don't know. I sort of think of gold often as just it's just another asset. It's not doesn't have any magical powers of really protecting you for inflation, though it has risen during inflation times. It's also risen as inflation has cooled. And so, yeah, I just think that these intermarket correlations and connections seem interesting, but I don't know if there's much of a material one. So I would just suggest that we analyze each one separately and not trade one as if it's a proxy for the other. So I'm looking for gold to pull back, like I am looking for the S&Ps to pull back. But I don't see that safe haven. I think really is cash and the short end of the U.S. curve.
Well, Mark, let's dig into your outlook on the Trump trade. Lots of people weighing in on this in the marketplace. Let's hear how you think things would shape up in a Trump win.
Yeah, so I think partly it's based on what's happened. How did markets respond to what Trump and now the vice president candidate Vance has said? And I think there's a few ways it's been expressed in the market. One, I think, is long crypto. They think that the connection between Vance, Silicon Valley, and Trump's reversal. At first, he didn't like crypto, and now he seems to like it more. So I think that crypto is one element. The second one is through immigration and tariffs. I think the market thinks that Trump does not like Mexico, and Mexico has its own challenges, of course, with that supermajority by the Moderno party and a possible election of judges has spooked international investors. And so I'd say second Trump trade after the buying crypto is selling the Mexican peso. Remember there, though, interest rates are high and the carry is high, which means that you really need momentum at your back. But we're seeing the peso having traded higher, recovering since maybe mid-June or so. I think that recovery of the peso is over. So we should be looking for lower peso levels, higher U.S. dollar against the peso, and partly fueled by domestic concerns, but also as sort of an element of the Trump trade. The third part of the Trump trade, I think, is people would expect the U.S. yield curve, which is still, we're looking at the 2 to 10 part of the curve, and that still is inverted, but less so. And so I think that the general view would be that for a combination of reasons, that is easier Fed policy and more supply at the long end, more debt, that we have a steepening of the U.S. yield curve. So it goes from inversion to positively sloped. And that means that the long end of the curve underperforms the short end of the curve. We were talking off mic about how the market understands this shifting in the curve. And I think we agree that the market oftentimes emphasizes the inversion as some kind of recessionary signal. But it looks like the most difficult economic period is when the curve writes itself out, when it goes from inversion to properly the normal slope. And that is what squeezes businesses. The sort of from going inversion to positively sloped, more than just going inversion the first time. So the third part of the Trump trade then, after the crypto, Mexican peso, would be the steepening of the U.S. yield curve. And the fourth trade seemed to be coming out of that Business Week interview where Trump had suggested that Japan is still taking advantage of us by letting the yen weaken and the trade surplus. And yet, just this week, Japan reported its trade figures. And if truth be told, Japan runs a trade deficit. It's a smaller trade deficit this year than last year, but it still runs a trade deficit, meaning it imports more than it exports. And it seems partly to make sense that what drives the Japanese current account surplus. So this is unusual, right? You have a country that has a trade deficit and a current account surplus. What fuels that current account surplus if trade is negative? Well, Japanese multinationals have overseas profits. Also, Japanese have invested in foreign bonds. They pay a yield stream that Japan repatriates. Think about life insurance companies and some of the large Japanese pension funds. Also, one of the big things that happened with the weaker yen is a surge in tourism. People are coming to visit Japan. It's a cheap vacation for many people in the world as the yen is at its lowest level in more than 30 years against the US dollar. So a strong yen, whether it's factually justified or not, sort of immaterial. We do know that the Japanese yen is about 65% undervalued on a purchasing power parity terms from the OECD. So if you think that the dollar is going to turn in any event, maybe cyclical factors like the Federal Reserve easing, the Bank of Japan likely to be raising interest rates. If you think this is going to turn the exchange rate, and then you've got the possibility of a Trump second term, just sort of putting more frosting on the cake, so to speak.
Mark, I want to go down that road of that yield curve steepening, the potential of the recession when it does turn positive. Does that bring in the potential of a major market correction, one that investors have been waiting for, even more so than 2022 when it was grinding lower and then rebounded after about, let's say, 3, maximum 4 quarters? Does a recession and a positive yield curve, does that cause markets to go through a much more significant crash?
Well, I think that's definitely the risk, right? And the economic slowdown, I think, and as we're going to see, right, next week we get the U.S. Q2 GDP. It looks like the Atlanta Fed has it at 2.7. I think the Bloomberg consensus, Bloomberg median of their survey is a little bit below 2%, which means that's faster than it was in Q1. But I think for many of us who think the U.S. economy really is losing steam and the turn is coming, even if it's not quite at hand in Q2, that this does poses a risk to corporations' valuation basis. It means that even if Trump promises to deliver tax cuts, then in the first instant, there'll be weaker demand, weaker pricing power, and this could squeeze corporate earnings. And so this is really an interesting development too, is the tension between, it used to be people thought the Republican Party was a party of business, and now it looks more likely that there's some different tensions between businesses and the Trump wing of the Republican Party.
Well, Mark, when you think about all these forces coming together, do you think that the market sometimes it looks so forward looking, it's looking so far ahead that it's been really, like we've talked about in the past, it's been incorrect on when these rate cuts were coming the whole time. It's been incorrect on when the recession would arrive. It didn't anticipate, I don't think anybody anticipated the markets to rip as high as they have, to just keep blasting to all-time highs. Is there anything that you think could derail what we think of as standard economics here, and it's just kind of in an uncharted territory?
And it's always a risk, right? And I think that that risk is that we could be in a different paradigm where these intermarket relationships that held under one paradigm no longer hold as we enter a new one. It's hard to say. I think that this is why like risk management is really becomes the key. You say the market's been wrong about the recessions and Fed cuts and all that, and it's true. It's maybe it was Yogi Berra that said about that predicting predictions are difficult, especially about the future. And it's true. And I think that what we do as market participants, it's really like odd. If the meteorologist says there's a 60% chance it rains, and I bring my umbrella and it didn't rain, was the meteorologist really off? Was he wrong because 60% chance? I'm not so sure. I think that as financial market participants, we have to like manage our risk. And these are all different ways to make scenarios and to try to like sort of like game out the different odds. So I think that what we ought to be doing, and that's what I've done personally, is tighten up my stops on some of my stocks that I own and thinking about what kind of levels, where would I like to be a buyer, what are value levels. And I think that's really the important thing is depending on what kind of like investor trader you are. But as an investor, you want to be a value investor and buying things below fair value. And sometimes that means like right now, there might not be a lot of things that are below fair value that we've been in like a buy everything, even if some markets have outperformed others. So it's really looking at undervalued assets and managing your risk accordingly. And that means you're using stops in the market, you use trailing stops to protect profits. I think these are the things that really separate people who take money from the market and people who don't.
Mark, we're going to end it here. Very interesting conversation. Thank you for sharing some of your insights and looking ahead for us to try to make sense of what the data is telling us and also what the markets could be telling us. I think we're all still waiting for that recession, all waiting for that bigger market correction. But as you said, the market's already given investors 15% this year, and we are only halfway through the year. Corrections are natural. Questions, is this a correction and still a very strong uptrend or a true change of direction? Only time will tell. Mark, thank you very much for your time. I will post a link to Mark's website, Mark to Market, in the show notes. That's where you can keep up to speed on what everything Mark is writing about, economic data and market moves. Mark, thanks for your time. I hope you have a great weekend.
Thanks. Good luck to everybody.